So in this video today, we're going to be talking about some of the best high-yielding dividend stocks in 2020. We're going to look at a list of the top 5 highest-paying dividend stocks that are currently on a list of stocks known as Dividend Aristocrats. Now, if you're not familiar, a Dividend Aristocrat is a company that has not only been paying dividends for 25 consecutive years or more, but they have been growing them every single year as well. So it's companies that have paid and grown their dividends every single year for 25 years or more. Because when it comes down to looking for a high dividend yielding stock, you want to make sure that that dividend is relatively safe. Because at the end of the day, dividends can be cut, restructured, or eliminated at any point in time. But by solely looking at these dividend aristocrats and looking for these companies that have a long track record of paying and growing dividends, you can mitigate some of that risk of them yanking the rug out from under you and eliminating that dividend. However, that being said, there's still no guarantee that a dividend aristocrat won't still cut their dividend. It just is a lower chance than a company that isn't on that list. So there's about 60 companies on this list of dividend aristocrats, and in particular, we're going to focus on the 5 companies currently paying the highest dividend yields, and we're going to talk about whether or not this may be a good investment. Now, that being said, guys, I just have to make this quick disclaimer here that I am not a financial advisor. This is not financial advice, and you should always do your own due diligence before doing any kind of investments on your own. That being said, guys, let's jump into the number 1 high-yielding dividend payer on the Dividend Aristocrats, and that is none other than Exxon Mobil. So Exxon Mobil trades under the symbol XOM, and they currently have a dividend yield of around 8.3%, which is significantly higher than what you typically find among dividend stocks. So for example, if you look at the S&P 500, which is the 500 largest publicly traded US companies, the average dividend yield sits around 2%. So Exxon Mobil is currently paying roughly 4 times that of the average of a publicly traded US company. But what I want you to keep in mind here is that the higher the dividend yield is, the greater the risk factor is as well. So when you see a company paying a dividend yield of 6, 7, 8%, understand that is because there is a significant amount of risk at play with the current business operations, which is of course the case here with Exxon Mobil. Now, Exxon Mobil does have an impressive track record here of 37 consecutive years of paying and growing their dividends, but here's the current situation with them. So right now, due to this global pandemic, oil prices and oil demand has plummeted, and this is a company that derives a lot of their revenue related to the price of oil and other commodities. Now, they currently have said they have a goal of doubling their earnings and doubling cash flow by the year 2025, which is a very ambitious goal. But their current situation financially is just not good. In fact, as far as their dividend goes, if you look at the payout ratio, it is currently over 200%, which essentially means Exxon Mobil is currently paying twice their current earnings out in the form of dividend payments to shareholders, which anybody could tell you that is not sustainable long term unless their earnings increase. So I would say due to this oil crisis going on right now, and also just less people being interested in fossil fuels and more interest in renewable technologies, the risk factor for Exxon Mobil is very high, and there is definitely a good chance here that they will have to pause the growth of that dividend or cut the dividend. As much as they would not like to do that, it is still a possibility, and the current dividend is not sustainable long term without an increase in their earnings. That being said, seeing as they have increased their dividend for 37 years, they have weathered many storms in the past. However, recently it was announced that they have suspended 401k matches for employers, clearly a sign of cost-cutting efforts, which could mean there are more to follow, such as a dividend restructuring. Alright, so coming in at number 2 on the list here is none other than AT&T, the telecom and media giant that trades under the symbol T. They have an impressive 35-year dividend growth streak, and their current yield sits at around 7%, which again is much higher than your average dividend payers on the S&P 500. Now, I would say AT&T has moderate risk, but not as much risk at play as Exxon Mobil based on their current situation. So most people are familiar with the telecom business associated with AT&T as a leading wireless carrier, but they're also a massive media company, primarily through their acquisition of Warner Media, and they own business units such as HBO and Warner Brothers. And another popular business segment that they own and operate is DirecTV. So they reach hundreds of millions of customers through their wireless business and through their media business. However, what I don't like about AT&T is they have massive investments in old media, which are losing subscribers left and right due to the overall trend of cord cutting. Now, they are involved in the streaming business with streaming services such as HBO Max and AT&T TV Now, but nobody really talks about these services. I don't know anybody who has them, and they're certainly not up there in the likes of Hulu, Netflix, and Disney+. So they're heading in the right direction, but they haven't quite executed in a way where they have gained meaningful market share in the streaming segment. And another problem with AT&T is all of these media acquisitions have led to a sizable debt load. So this company does have a substantial amount of debt, which could inhibit their ability to pay dividends down the road or at least grow them at the pace that they have. So right now their payout ratio sits at around 126%, which means they are paying more in dividends than they are currently earning. Again, not sustainable unless earnings increase significantly. However, that being said, the bullish perspective here is that with the rollout of 5G, they should be able to derive more revenue from their wireless segment, which is still growing at a healthy rate. So there's definitely some level of risk here with AT&T, but I would say not as much as Exxon Mobil. The main thing is that if you look at AT&T stock over the last couple of years, it's been basically flat with pretty much no growth. So it's significantly underperformed the overall stock market. Alright guys, so before I get into number 3, I just want to mention if you're looking to get started with investing in the stock market, there's a great commission-free brokerage out there called Webull, which is offering new users who sign up 2 completely free stocks. So you get your first free stock when you open up the brokerage account, and you get the second free stock when you fund it with $100 or more on your initial deposit. So if you're looking to start investing and you want to grab 2 free stocks, that's going to be the top link down in the description below. And full transparency here, guys, I am affiliated with Webull, so I may earn a commission in the process. All right, so coming in at number 3 on the list here is a much lesser known company called People's United Financial, trades under the symbol PBCT. They have consecutively grown their dividend for 26 years, making them a newer addition to that list of dividend aristocrats, and the current dividend yield is sitting at around 6.7%. Now, this is a banking company involved with commercial, retail, and business banking, as well as a variety of different wealth management services. However, this is a much smaller bank than many people are used to. So their current market cap sits at around $5 billion compared to Wells Fargo, a massive bank with a market value of around $100 billion. So this bank is like 1/20th the size of Wells Fargo, making them a much smaller operation. Now, the current payout ratio is sitting at 62%, so based on current earnings, they should reasonably be able to pay that dividend and hopefully continue to grow it at a reasonable rate over time. But this is definitely a stock you're going to want to do some more research on, and oftentimes when trying to research smaller companies, there's less information available, and it's hard to get a good idea of the bullish thesis and the bearish thesis of a given company. It's much easier to research companies with, larger market capitalizations since there's more people publishing research and documents about them. The financial sector was hit pretty hard here due to this global pandemic because people were fearful of consumers and businesses defaulting on their obligations. And while that is still a significant risk factor, I would say a lot of those fears may be in the rearview mirror, and we'll have to see how the next 6 months play out in terms of people getting back to work and businesses resuming. All right, so coming in at number 4 on the list here is another massive oil giant referred to as Chevron that trades under the symbol CVX. They have a 32-year dividend growth streak, and they currently pay a yield of around 6.2%. So the yield is not as high as Exxon Mobil, but neither is the risk factor associated with that investment. What I want you to keep in mind, as mentioned earlier, the higher the dividend yield, the greater the risk factor becomes. So Chevron is basically having the same exact struggles as Exxon Mobil. They're involved in an industry that is kind of dying out in terms of people's interest, and we're focused more on green renewable energy and companies like Tesla, and not so much, investing in fossil fuels. And just like with Exxon Mobil, weak commodity prices have crushed their margins, and there's really no signs of recovery anytime soon due to the slowdown of travel associated with this global pandemic. Now, on the bullish side of things here for Chevron, a lot of bulls have said that they have done a great job at buying quality assets over time and not overpaying for them, which is something that a lot of their peers have done in the past, overpaying for oil assets and other commodity assets. But on the other hand, one risk factor here is that a lot of Chevron's business is involved in upstream segments such as oil financing and exploration, making them more susceptible to the price fluctuations of commodities. And not to mention, there was a huge move in the oil segment recently when a key competitor, BP, announced that they were slashing their dividend and pivoting their focus away from oil and fossil fuels and into renewable energies. So that kind of shook people and got them scared that a similar path is going to happen with Chevron and Exxon Mobil. So there is a significant amount of risk at play here in the oil industry. It's not one I have personally ever invested in, and I don't think I ever would. However, the yields on these stocks are still significantly higher than most other dividend payers out there. And finally, guys, coming in at number 5 is a company you may or may not have heard of before, and that is Franklin Resources, trading under the symbol BEN. Now, based on the name, you might think this is an energy company, but it's actually a financial company involved in asset management. This company has an impressive 38-year dividend growth streak, and they currently pay a yield of 4.94%, just under 5% yield. So this is a massive investment management company, most well known for Franklin Templeton. So they are a provider of mutual funds and other fixed income investments and different financial products like that. As of 2018, they had around $700 billion in assets under management. However, recently they just acquired another asset management company called Legg Mason, which now brings their total assets under management to around $1.4 trillion. The way this company makes money is pretty simple. They manage assets for other people, and they collect a management fee in the process, and that is where 2/3 of their total revenue is derived from. Now, while that is a great business model that works really well during economic prosperity, there is a significant risk factor here because when the market tanks as it did earlier this year, a lot of people pull out of the market, and when 2/3 of your revenue is derived from management fees and you have lower assets under management, well, all of a sudden your revenue plummets as well. Not to mention, there's also less overall interest in mutual funds and some of these more traditional investments as more people pivot towards low-fee index funds, robo-advisors, and things like that. However, their current payout ratio is sitting at just 39%, which makes this a relatively safe investment with very low risk of that dividend being cut or restructured in the near future. So anyways, guys, there you have it. Those are 5 high-yielding dividend stocks to keep an eye on and consider in 2020. And again, we're focused solely on the dividend aristocrats because these companies have the greatest likelihood of continuing to grow and pay those dividends going forward. Sure, you can find 10 to 12% yields or more, but the risk of that company cutting and or eliminating that dividend is sky high. And for a long-term investment, that's just way too speculative. So anyways, guys, I hope you enjoyed this video. If you want to grab those 2 free stocks, that's the top link down in the description below. Make sure you subscribe, hit that bell, drop a like, do all that stuff if you don't mind, and I hope to see you guys in the next video.